Imagine this. You're running a business, maybe, and your customers, they're buying your stuff pretty steadily. Nothing crazy, just consistent. But then you look upstream at the orders from your distributors, and they're all over the place. Wild swings, up, down. And here's the kicker. When you turn around and order from your suppliers, those swings are even bigger, like pure chaos sometimes. So the question is, how does steady buying at one end lead to such a mess further up the chain?
Yeah, it's a really common problem.
Well, what you're seeing there, that's a classic case of something called the Bullwhip Effect.
Mm-hmm.
And in this deep dive, that's what we're going to unpack, this whole phenomenon. We want to figure out what causes it, and maybe more importantly, uncover some really smart ways companies are trying to tame that whip, bring some calm back.
Mm-hmm.
And what's really key here, I think, is understanding that it's often not about people being irrational. It's about rational choices inside the system itself.
Absolutely. And that distinction matters hugely because these distortions, they create massive inefficiencies, hidden costs right across the board. We're talking about things that seriously hit the bottom line, tie up capital and inventory you don't need, and ultimately hurt customer satisfaction. It's a big deal.
Okay, so let's get into it then. What exactly is the bullwhip effect? Define it for us.
Okay, so the research basically defines it like this. Demand order variability gets amplified, gets bigger as you move up the supply chain, away from the final customer. And this happens even if that end customer demand is actually pretty stable.
Huh. Like cracking a whip, right? Small movement at the handle.
Exactly. It creates that huge snap at the end. Same idea, but with orders.
Okay. You mentioned some examples earlier, the historical ones.
Yeah, they really paint a picture. Procter & Gamble, P&G, famously ran into this with Pampers diapers. I mean, babies, they consume diapers at a pretty predictable rate, you'd think.
Right. Steady demand.
But the P&G execs kept seeing these huge swings in orders from their distributors. Total surprise. And then when P&G ordered their own raw materials from suppliers like, say, 3M, the swings were even wilder.
Wow.
Yeah, and that's actually where they coined the term bullwhip effect. P&G did.
No kidding. Okay. And HP Hewlett-Packard?
Similar story. They saw their printer sales at a big reseller fluctuate, normally, market ups and downs.
Sure.
But the orders coming from that reseller to HP, much, much bigger swings.
Ah.
And then orders from HP's printer division to their own internal chip division, even more dramatic, just amplified all the way up.
It's fascinating how that distortion just ripples, or rather whips, through the whole system.
It really is. And the symptoms are pretty consistent and very costly. You get tons of excess inventory. Our sources pointed to grocery chains sometimes holding over 100 days of supply.
100 days?
Yeah. And for raw materials in tech or pharma, it could be over a year's supply just sitting there.
That's just tying up massive amounts of cash.
Exactly. And it leads to bad forecasts. You end up with either too much capacity or not enough. Customer service suffers, products aren't available, or you have these huge backlogs. Makes planning production a nightmare. And then you pay through the nose for fixing it, expedited shipping over time. It all adds up.
What kind of scale are we talking?
Yeah.
The cost?
Well, just one initiative, the Efficient Consumer Response, or ECR, they estimated something like a $30 billion opportunity just by smoothing things out in the grocery supply chain alone.
$30 billion, just groceries.
Yep. And you consistently see this pattern. Orders always show more variability upstream than downstream. It's almost a law of supply chains.
Is that like the beer game thing I've heard about?
Precisely. The beer game is a great simulation that shows exactly this. Simple ordering rules at each step, but you get these massive swings up the chain by the end. But here's the crucial point, the thing that comes up again and again in the research. This isn't happening because people are making crazy, irrational decisions. It's a consequence of rational people making logical choices within the structure of the supply chain as it is.
Okay, that's the really interesting twist. If it's rational behavior causing it, then how on earth do you fix it? You can't just tell people to stop being rational.
Exactly. That's the puzzle. Right. If it's rational, how do we fix it? And that understanding is absolutely key because each of the four main causes we're about to talk about, they stem from someone in the chain making what looks like a perfectly sensible decision for their part of the business.
Right.
But when you add them all up, collectively, it just backfires and creates this whip effect.
Okay, that totally shifts the perspective. It's not about fixing people, it's about fixing the system.
Precisely.
All right, let's dive into those four causes then. What's the first one?
Okay, first up is demand forecast updating. Makes sense, right? Every company forecasts. And they usually base that forecast on the orders they get from their immediate customer. That's the main signal they have.
Okay, logical enough.
So when a downstream company places an order, the manager upstream sees that as new information about future demand. And they, quite reasonably, tweak their own forecasts and their own orders based on that signal.
Makes sense.
But think about how that cascades. You might use something like exponential smoothing, a common technique where you're constantly updating your view of future demand and how much safety stock you need. The issue is, each little update, each adjustment gets passed upstream and potentially amplified. So the orders placed further up the chain fluctuate way more than the actual end consumer sales. And the longer the lead time, the time it takes to get resupplied, the worse it gets. Because everyone needs bigger safety buffers to cover that uncertainty, which exaggerates the order swings even more.
So wait, just trying to be prudent, trying to forecast based on the orders you see, that creates the problem for everyone else.
In a way, yes, it's a rational response, but within a system where information is fragmented and lagged, that's the crux of it.
Wow. Okay. What's cause number 2?
The second one is order batching. This is basically when companies group orders together instead of ordering small amounts frequently.
Why would they do that?
Again, usually for perfectly rational reasons. One is periodic ordering. Maybe they only place orders weekly or even monthly. Why? Well, maybe processing each order costs a lot. P&G, for example, figured each customer invoice cost them like $35 to $75 to handle because of all the manual steps involved back then.
So it's cheaper to do fewer, bigger orders.
Right. Or maybe their planning systems, their MRP systems only run once a month. So boom, you get one big order, then nothing for weeks, creates spikes.
Okay.
Then there's transportation economics, shipping costs, right? Sending a full truckload, FTL, is way, way cheaper per item than sending a less than full truck, LTL.
Definitely.
So it's totally rational for a company to wait until they can fill a whole truck, even if that means ordering a month's worth of stock, maybe more, all at once.
And that creates another big spike for the supplier.
Exactly, even if the company itself is using the product smoothly day to day.
Okay. Any other kinds of batching?
Yeah, there's also a kind of periodic ordering driven by the customer's side, but it creates batches for the supplier. Think, push ordering. This is where you see regular surges because of things happening at the customer's end, like salespeople pushing hard to meet end of quarter quotas.
The hockey stick effect.
That's the one. Creates this huge spike in orders right at the end of the period. The Navy even saw this with recruiters bringing in more people right before their performance evaluations. So the supplier sees this really erratic pattern that doesn't match actual usage at all.
Okay.
And if lots of customers are on similar cycles, maybe they all run their planning systems at the start of the month and those spikes all land at once, making the variability even worse. Some people call that MRP jitters.
It really is like that game of telephone, isn't it? Everyone just passing along the message, maybe adding their own little rational tweak, and by the end, it's completely distorted.
That's a great way to put it. Which leads us nicely into the third cause, price fluctuation.
Sales and promotions.
Exactly. This causes forward buying. Customers buy way more than they need right now simply because there's a deal, a discount, a coupon, whatever.
Makes sense from the buyer's perspective.
Yeah.
Stuck up while it's cheap.
Totally rational for them. But the scale is huge. One study suggested 80% of grocery transactions involved forward buys. We're talking like $75 to $100 billion worth of inventory just sitting in the system because of these deals.
Billion, wow.
Yeah. And the result, when the price is low, customers load up. Warehouses bulge. Then, when the price goes back to normal, they just stop buying. They work through that extra inventory.
So their buying pattern looks nothing like their actual consumption.
Not even close. It's way more volatile. One source we looked at literally called this promotional strategy the dumbest marketing ploy ever because of the chaos it causes.
I can see why.
Yeah, you get factories slammed with overtime 1 minute, then sitting idle the next, huge inventory costs, extra shipping fees to rush things, more product damage from handling. It's a mess.
Any specific company examples of this?
Bristol-Myers Squibb had a rough time once. Their stock tanked because sales were way lower than expected. Why? Because earlier trade deals had flooded the market with forward buy inventory, so nobody needed to order for a while. And you see charts showing this clearly, like a soup maker, whose retail sales are seasonal but fairly smooth, but their shipments to distributors are swinging wildly because of promotions.
Okay, that makes sense. So forecasting issues, batching, price games. What's the fourth cause?
The last one is rationing and shortage gaming. This happens when demand outstrips supply.
Okay.
So the manufacturer can't fill all the orders. What do? Often they ration. Maybe they allocate the limited stock based on the size of the orders they received. Say everyone gets 80% of what they ordered.
Right. Seems fair, maybe.
But customers quickly figure this out. They know they'll likely be rationed. So what's a rational thing for them to do next time?
Order more than they actually need, hoping to get the amount they really want after rationing.
Bingo. They game the system by exaggerating their needs.
Ah, I see.
But then maybe demand cools off or supply catches up. Suddenly, all those inflated orders just vanish. Cancellations flood in.
So the orders the supplier sees are almost useless for figuring out real demand.
Pretty much. It becomes a self-fulfilling prophecy of chaos. Fear of shortage leads to actions that create the appearance of a massive shortage, followed by a glut.
Right, because everyone's inflating their orders just in case.
Exactly. We saw this play out dramatically in the 80s with DRAM memory chips. A perceived shortage made orders skyrocket, not because people were using more chips, but purely out of fear and gaming. Customers were placing duplicate orders with multiple suppliers, planning to cancel the ones they didn't need later.
Nightmare for the suppliers.
Total nightmare. HP had it with an early laserjet printer. They rationed, orders went through the roof, but they had no clue how much was real demand versus these phantom orders. When they finally ramped up production, cancellations poured in, cost them millions in inventory they didn't need and capacity they built unnecessarily.
Ouch.
Motorola, same thing with cell phones in the early 90s, and then again later. Distributors massively overordered, fearing shortages. Motorola reported record profits, Wall Street cheered. Then the stock tumbled when analysts realized the dealers were just drowning in phones they couldn't sell.
So even good news can be bad news if it's driven by this effect.
Absolutely. IBM had a similar issue with Aptiva PCs in '94. Resellers jacked up orders, afraid of shortages, but IBM was flying blind on true demand versus rationing-induced panic buying.
Okay, this is quite the picture of systemic dysfunction, even with everyone acting rationally.
It really is.
So now for the hopeful part. Here's where it gets really interesting. We understand the causes now, but what can companies actually do? How do you fix the system, tame the whip?
Right. And the solutions, interestingly, mirror the causes. They focus on changing the underlying infrastructure and the processes, not just blaming people. The research groups the main strategies into sort of three buckets: information sharing, channel alignment, and operational efficiency.
Okay, let's take them one by one. How do you counteract those problematic forecast updates?
So for multiple demand forecast updates, the big lever is information sharing. You need to get that downstream demand data, what the end customer is actually buying, visible further upstream.
Makes sense. Cut out the middleman guessing game.
Exactly. So you see computer companies like IBM, HP, Apple requiring their resellers to provide sell-through data, actual sales data. And things like EDI, electronic data interchange, play a huge role, just swapping business documents electronically. That grew incredibly fast, from maybe 20% of orders in consumer goods in 1990 to nearly 60% just 5 years later. Makes data flow faster and cleaner.
Okay, information sharing. What about channel alignment?
For channel alignment, things like VMI, vendor-managed inventory, or CRP, continuous replenishment programs, are really powerful. This is where the supplier basically takes over managing the inventory at the customer's location.
So the supplier decides when and how much to ship.
Yeah. They get access to the customer's real-time demand and inventory levels, and they manage the resupply. Companies like Campbell Soup, Mars, P&G, TI, Apple, lots of big names use this.
What's the benefit?
Big inventory reductions, often up to 25%, because the supplier has better visibility and removes that downstream forecasting step entirely.
Clever. And operational efficiency.
For operational efficiency, anything that reduces lead times helps. Just-in-time replenishment, for example, if you can resupply faster, you don't need as much safety stock, you don't need to forecast as far out.
Right. Less time for errors to build up.
Exactly. Or sometimes companies bypass the downstream channels altogether, like Apple selling direct or Dell's original direct model that gives them perfect visibility into end customer demand.
Okay, so making the chain faster and more transparent deals with the forecasting issue. What about breaking those big, lumpy order batches?
Right. For breaking order batches, again, information sharing helps. EDI, for instance, drastically cuts the cost of placing an order. Remember P&G's $35, $75 invoice cost? GE apparently got paper PO costs down from $50 to like $5 using EDI. If ordering is cheap, you can do it more often in smaller amounts.
Makes sense.
Nabisco uses computer-assisted ordering, CAO, just to make frequent ordering easier.
Okay, and channel alignment for batching.
For channel alignment here, you can change the incentives. AENG, for example, offers discounts if customers order a mix of different products, different SKUs on the same truck.
So you can fill a truck without ordering a huge amount of just one thing.
Exactly. Or some British retailers use what's called composite distribution trucks with multiple temperature zones carrying lots of different types of products together. Again, facilitates smaller, more frequent deliveries of a wider range of goods.
Smart logistics. What about the operational side?
On the operational efficiency front, using third-party logistics providers, 3PLs, can really help. They achieve economies of scale by combining shipments from multiple suppliers or delivering to multiple customers on the same truck.
So smaller companies can get the benefits of FTL shipping without placing huge orders.
Precisely. It levels the playing field. And P&G also started coordinating regular delivery appointments with customers, spreading out deliveries across the week instead of everyone getting trucks on Monday. Smooths out the flow.
It really sounds like shifting focus from optimizing individual truckloads to optimizing the flow through the whole system.
That's a perfect way to put it, changing the rational calculation.
Okay, third cause, stabilizing those fluctuating prices that cause forward buying.
For stabilizing prices, the most direct channel alignment approach is simply, well, stop doing so many deep discounts and promotions.
Easier said than done, maybe.
Perhaps. But manufacturers are increasingly moving to EDLP everyday low price or value pricing strategies. P&G is the famous example again. They cut their list prices pretty significantly, 12-24%, but slash the trade promotions. Result: their highest profit margins in decades and market share gains. It removed that incentive to forward buy.
So stable prices lead to stable ordering patterns.
Largely, yes. And operationally. From an operational efficiency perspective, good cost accounting helps. Using activity-based costing, ABC, lets companies actually see the huge, often hidden costs associated with those promotions. You know, the extra inventory, the warehousing, the special handling, the rush freight. Once you quantify that, the move to EDLP looks a lot more rational, even if marketing loves a big sale.
Right, you need the data to make the case internal. I can imagine pushback against ditching promotions, though. Customers get used to them. The sources mention that.
Oh yeah, it's definitely a change management challenge. P&G certainly found that. It requires clear communication, managing expectations. You have to sell the long-term benefits of stability and consistent value over the short-term buzz of a discount.
Okay, makes sense. Last one then, eliminating that shortage gaming.
Right, eliminating gaming. For channel alignment, the key is to change how you allocate products during a shortage. Instead of basing it on current orders, which you know might be inflated.
Base it on
past sales history. Allocate proportionally to what customers have actually sold in the past, not what they're ordering right now.
That removes the incentive to inflate the current order.
Exactly. General Motors apparently did this for a long time, and companies like TI and HP started switching to it. Makes gaming pointless.
Clever. What about information?
Information sharing is big here too. Just be transparent. Share your capacity status, your inventory levels with customers. If they know you have product or they know what's coming, they feel less anxious and less need to game the system.
Reduces the fear factor.
Right. And working with customers to get orders placed further in advance helps everyone plan better.
And finally, operational efficiency for gaming.
On the operational efficiency side, you can simply enforce stricter rules about canceling orders. If customers know there's a penalty for placing huge phantom orders and then canceling them, they'll be less likely to do it. Some computer makers started doing this, makes gaming less rational because it has real costs attached.
So across all these causes and solutions, the theme seems to be increase visibility, align incentives across the chain, and improve the efficiency of the actual operations.
That sums it up perfectly. It's about building a more coordinated, transparent, and rational system.
You know, what's truly fascinating about all this is that realization that the bullwhip effect isn't some weird bug. It's not irrationality. It's actually a logical outcome of rational players acting in their own best interest within a fragmented system. It's obviously a massive challenge, causes huge waste. But this deep dive really shows that by understanding where it comes from, those rational roots, we actually gain the power to tackle it, not by fixing people, but by fixing the system they operate in.
Absolutely. And maybe that brings up a final thought. For you listening, think about your own supply chains. Could be managing your kitchen pantry, could be ordering for a small shop, could be a huge global operation. Where in that chain might there be a bit too much whip? Where could things benefit from a little less guesswork and a little more coordinated, transparent flow based on what we've discussed?
Yeah, something to think about. We hope this deep dive helps you look at the products you use every day and the complex journey they take to reach you, with maybe a slightly different, more informed perspective.